Hi, welcome to our channel of IGNOU audiobooks, Indira Gandhi National Open University, School of Management Studies, SOMS, Diploma Postgraduate Diploma Programs. Postgraduate Diploma in Financial Markets Practice, DFMP. MFP1 Equity Markets. Block-1 Introduction to Currency Markets. Unit 1 Evolution and Significance. Objectives. After studying this unit, you should be able to times identify the components of the Indian financial system, times understand how the financial system works, times know the evolutionary process and significance of financial markets, and times appreciate the major developments and milestones in the Indian financial markets. 1.1 Introduction. The financial system of a country is critical for its development and growth. In the contemporary era of globalization, it is critical to align the economic structure in line with the developed economies. At the same time, the core objective of the Indian financial system needs to cater to the growth and development of India. The Indian financial system has evolved over the past several decades since independence. Before identifying the core developments in the Indian financial system, let us understand the constitution of a financial system. In this section, we shall introduce the financial system and its components, as well as their interdependencies. A system is a collection of components, usually referred to as subsystems, that interact with each other. A financial system is a comprehensive integration of many subsystems, comprising of financial institutions, markets, instruments and services that facilitate the efficient and effective transfer, allocation and utilization of resources funds. The different components subsystems of a financial system are as follows. 1. Financial markets. 2. Financial institutions. 3. Financial assets instruments. 4. Services. The financial system of any economy provides the foundation for growth and development. Countries that are rich in resources, be it natural, human or any other form, require to plan and strategize the development of their financial systems. Indian financial system includes financial intermediaries, financial markets, financial assets instruments, financial services, the government and business entities, including corporate, banks, financial institutions, etc., require capital for investment and operations. On the other hand, the householders, general public are net savers of capital and hence deposit their savings in banks and financial institutions. In this process, this capital is channelized, either directly or through the financial intermediaries such as banks and financial institutions, to the entities that require capital. A robust financial system ensures that adequate management control systems are in place to ensure that this process of transfer of funds is transparent. Effectiveness of a financial system is in ensuring that there is no misuse of funds, as well as no default by any of the entities in the financial system. This is extremely important, due to the fact that if there is a default by any of the entities, this would result in a lack of confidence among market participants. Thus, a financial system facilitates transfer of funds from entities that are in surplus to entities that are in deficit. This transfer of funds occurs either directly or through the financial intermediaries. The entities that are having a deficit of funds can sell financial claims in the form of instruments on themselves. These financial claims are in form of bonds and treasury bills issued by government, debentures, shares and commercial papers issued by corporate, fixed deposit receipts and savings bonds issued by banks, financial institutions, mutual funds issued by asset management companies, etc. These instruments can be bought by those who have surplus funds, either directly or through intermediaries. The reason for buying these instruments may be as follows. A. Household savings would be safer in the hands of government institutions that guarantee repayment of funds, both principal and interest accumulated over a period of time. B. Returns linked to the risk involved in the investment vehicles depending on the risk appetite of the depositor. This provides supplemental income to the surplus funds holder. Note that idle money has opportunity cost. C. Opportunity to save on tax by investing in specific instruments applicable for tax exemption rebate. D. Need for insurance to mitigate risk, life insurance and general insurance, e.g., motor vehicle insurance, home insurance, etc. E. Diversification of asset PAE for the investor. Benefits of direct transfer of fund. An entity requiring funds can sell the instruments directly to the entities that have surplus funds. This method is more EOT efficient as it ensures that there are no intermediaries between the investor of fund and the user of the funds. Transfer of funds through financial intermediaries. Usually large corporate, banks and financial institutions have economies of scale by distributing the financial products through specific channels of distribution, including banks and post offices. This increases the geographical reach for the issuer and hence minimizes the costs. For example, an investor living in a remote village can deposit his savings in a post office, i.e., more easily accessible. Another benefit of an investor availing the services of financial intermediaries is the advisory services for wealth management. The layman investor who may require guidance for investing in different markets can avail the services of wealth management experts in financial intermediaries. Such advisory services should be impartial and transparent in providing information to investors. Capital flow in an economy. The following diagram illustrates the capital flow into different sectors of the financial markets and real economy. The surplus funds generated as a result of earnings is either invested or saved in either the economy. The funds subsequently flow into business activities for production of goods and services, infrastructure growth and other developmental activities. Look at the screen. Funds are invested in the capital and money markets, foreign exchange markets, commodity futures markets, banks, financial institutions and other intermediaries offering financial services, or in the real economy in the form of physical commodity, real estate, etc. Ultimately, the funds are channeled towards production of goods, providing services, developing infrastructure and other economic activities, leading to the overall growth and development of the economy. Financial markets. Market is conventionally defined as a place where buyers and sellers meet to exchange goods, services, or even financial products, i.e., instruments for consideration. This consideration is usually money. In an information technology-enabled environment, buyers and sellers from different locations can transact business in an electronic marketplace. Hence, the physical marketplace is not necessary for the exchange of goods or services for a consideration. Electronic trading and settlement of transactions has created a revolution in global financial and commodity markets. Markets can also be defined as channels through which buyers and sellers exchange goods, services, and resources. Markets may be classified as follows. Times a product market where goods and services are traded. Times a factor market where labor, capital, and land are exchanged, and times a financial market where financial claims are traded. A financial market is a system of processes and functions that are usually regulated by means of rules and guidelines for enabling participants to transact in financial products and instruments, financial claims. In the process of the continuous interaction between the different entities that provide the demand and supply of these financial claims, the fair value of the financial claim is discovered. This is also referred to as price discovery. Traditionally, transactions used to take place only in unorganized marketplaces. These unorganized marketplaces were not subject to specific rule or regulation. When countries developed and as economies evolved, the need to regulate markets in order to remove distortions and to facilitate free flow of funds gave rise to regulatory bodies. The concept of organized markets evolved in order to entrust confidence among market participants. The traditional organized financial markets in India are 1. Money markets, for maturity of less than or equal to 1 year. 2. Capital markets, for maturity of more than 1 year. A. Equity markets. B. Debt market. Other emerging organized securities markets in India that have played a significant role in the last decade are the organized commodity markets, for exchange-traded commodity futures, launched in 2003, and organized currency markets, for exchange-traded currency futures, launched in August 2008. The capital markets comprise of the equity markets and debt market. New equity stock offering is issued in the primary market. Corporates issue new equity stock for raising capital towards expansion of business activities. The stocks that are issued are subsequently listed on the Indian equity exchanges, NSE, BSE, and other regional exchanges, which comprises the secondary markets. The components of the Indian financial markets include not only the capital markets and money markets, but also the foreign exchange markets, insurance IPFI pension, fund markets, loan markets, and savings and investment markets. 1.2 Developments in the Indian financial system. Having analyzed the different components of the Indian financial system and their interdependencies as well as the criticality of capital flows for the overall growth and development of economy, we shall identify the major developments in the Indian financial system during the past several decades. In the pre-independence era, the securities market was devoid of financial institutions that could provide long-term financing for the industry. This restricted the access to savings funds for the industry. Generally, for growth to take place, investments need to be made. Due to the absence of a robust financial system, the lack of capital flows affected growth and development. In the post-independence era from 1947 to middle of 1980s, planned economic development in the form of the five-year plans, which commenced in 1951, ensured development of infrastructure. The introduction to economic planning led to distribution of economic resources. This had implications for the growth and development of the country. Nevertheless, the mixed economy followed by the Government of India led to protectionist policies. There were restrictions on imports, exports, and manufacturing, based on license quota. The dominant fear of market failure provided the rationale for active state intervention in the financial system. But until end of 1980s, the 5-year plans largely ignored the role of financial system in the development process. Due to the lack of transparent market mechanism to facilitate price discovery, the financial system in India had a limited role in the overall development. In the 9th 5-year plan, it was widely recognized that the transformation of savings into investments could be largely facilitated by way of financial intermediation. The Government of India nationalized privately owned banks into government-owned enterprises. This was aimed at ensuring equitable growth of the entire economy to benefit all sections of the economy. Following are the major events pertaining to restructuring the financial system in the post-independence era. Times 1948, Reserve Bank of India was nationalized. Times 1956, State Bank of India was established by takeover of the then Imperial Bank of India. Times 1956, over 245 life insurance companies were nationalized to form the Life Insurance Corporation of India, LIC. Times 1969, nationalization of 14 major commercial banks. Times 1972, the General Insurance Corporation was established. Times 1980, 6 more commercial banks were nationalized. The nationalization of banks resulted in significant changes in the banking system. The need to establish systems and processes based on which lending is permissible towards assisting corporates to access working capital lead to the formation of the Tandon Committee, 1974, and Chore Committee, 1980. These committees enabled specifying norms for credit lending. New financial institutions for term lending facilities were established. These institutions were both at central government level and state level. This also resulted in the formation of the Unit Trust of India, an investment trust organization. Also, the pension and provident funds were brought under government control in terms of regulations governing their investments. Thus, the entire financial system was controlled by the government. Establishment of development banks, financial institutions, term lending institutions ensured availability of credit for industry. The government intervention also ensured that capital was disbursed in areas of priority. In other words, capital was directed towards development. Following are the major events associated with establishment of government-owned entities for the development of the Indian financial system. Times 1948, Industrial Finance Corporation of India was established. Times 1951, under the State Financial Corporation Act, financial institutions at the state level, State Financial Corporation or the SFC, were established. These institutions aided the small and medium-scale enterprises. Times 1954, the National Industrial Development Corporation, NLOC, was established for a more dynamic involvement in industrial growth. Times 1955, the Industrial Credit and Investment Corporation of India, ICICI, Limited, was established as a development banking institution. This pioneered underwriting of capital issues and channelization of foreign currency loans from the World Bank to private industry. Times 1958, the Refinance Corporation of India, RCI, was created to provide refinance to banks against firm loans granted by them to medium and small enterprises. This entity later merged with the Industrial Development Bank of India, LDBI. in 1964. Times 1964, Establishment of Industrial Development Bank of India, IDBI, as a subsidiary of RBI. IDBI not only disbursed funds towards planned economic development, but also coordinated the activities of all other financial institutions. IDBI was delinked from RBI in 1976 and was converted into a holding company. Times 1971, the Industrial Reconstruction Corporation of India, IRCI, was established jointly by IDBI and LIC to look after rehabilitation of sick mills. This was renamed as the Industrial Reconstruction Bank of India in 1984. This was once again converted into a full-fledged public financial institution, PFI, and was renamed as the Industrial Investment Bank of India in 1997. The establishment of the State Industrial Development Bank of India, SIDBL, State Industrial Investment Corporations, SILC, and the Technical Consultancy Organizations, TCO, at the state level ensured percolation of benefits to the grassroots levels of the society. This also aided in reviving growth and development of the Indian economy. Commercial banking between 1950 and 1985 saw the utilization of short-term deposits to fund trade and commerce. Industrial financing accounted for a small fraction of the total bank credit. RBI attempted to orient the operations of the commercial banking activities towards the growth and development of the Indian economy. Control of the macroeconomic variables under the purview of central bank enabled selective credit controls and moral suasion. This ensured that commercial banking activities supplemented the impact of development banks on industrial growth. Commercial banks were encouraged to underwrite new corporate issues and also provide term lending facility. Their exposures in these areas were refinanced by the Refinancing Corporation of India. Joint underwriting by a consortium of banks and insurance companies mitigated risk to a large extent. Banks also extended financial assistance by investing in shares debentures of corporate enterprises. Commercial banks were also encouraged to increase their exposure to small-scale industries, exports and agriculture. Credit Guarantee Corporation, CGO, was established to cover all credit made available to small-scale industries as part of the Credit Guarantee Scheme, CGS. For encouraging credit towards export-oriented units, the Export Credit and Guarantee Corporation, ECGC, was established. This was earlier known as the Export Risk Insurance Corporation. Agricultural financing was guaranteed by the Agricultural Refinance Corporation, ARC, which was established in 1963. The ARC provided refinance for all agri loans made by banks and financial institutions. In order to protect investors, apart from establishing the financial institutions, a comprehensive legal framework was created, as follows. Times Companies Act, 1956. Times Capital Issues, Control, Act, 1947. Times Securities Contract, Regulation, Act, 1956. Times Monopolies and Restrictive Trade Practices Act, 1970. Times Foreign Exchange Regulation Act, 1973. The G.S. Patel Committee on Stock Exchanges Reforms was appointed in 1984. This led to the establishment of the Securities Exchange Board of India, SEBI, in 1988. In Section 1.2, we have identified the major developments in the Indian financial system in the post-independence period. In the following section 1.3, let us analyze the development of global financial markets that has significantly influenced the development of Indian financial markets. Components of Indian financial markets. Look at the screen. Times capital markets comprises equity markets, debt markets, and derivatives. Market participants include financial institutions, high net worth individuals, HNI, and even retail investors. Times money markets, short-term debt securities issued by government, treasury, bills, commercial paper, certificate of deposits, repo and reverse repo, transactions, etc. Banks, primary dealers, HNI, mutual funds, insurance companies. Pension funds are the major participants. Times foreign exchange markets, dealing in foreign currency by importers and exporters with authorized forex dealers such as banks. This also lately includes currency futures traded on exchange platform. Participants are banks, corporate, importers, exporters. Times loan markets consists of commercial and retail loans to corporate and non-corporate borrowers. Loans are issued by intermediaries such as banks with surplus funds. Times insurance pension fund, business of selling insurance products, retirement products and deploying such funds for investment purposes. Institutions include LIC, GIC and other insurance companies, pension funds. Times savings, investments market, consists of commercial and retail savings. Major players are banks, financial institutions and finance companies, mutual funds, chit funds, nidis, etc. In this section, we have analyzed the developments in the Indian financial system in the post-independence era up to the commencement of liberalization of the Indian economy. This is critical for understanding the evolution of the Indian financial system over several decades of the 20th century. 1.3 Evolution of global financial markets. The earliest known organized market dates back to the 2nd century BC. The Roman Empire had developed many characteristics similar to modern capitalism. Markets flourished because the contemporary Roman law allowed the following activities. Times free transfer of property was permitted. Times money could be lent based on interest charges. Times money changers were allowed to deal in foreign currency. Times payment across the Roman territories could be made through bankers' draft.
The above activities enabled free flow of funds between those with excess funds in entities to those that required capital. Traders used to assemble at the Forum, near the Temple of Castor in Rome and buy, or sell, the following. Shares and bonds of fanning companies. Various goods on cash and on credit. Farms and estates in Italy. Ships. Storehouses. Cattle and other livestock. There is even a mention of the personality of traders, in line with the bulls and bears of the modem markets. Shares were classified into large executive shareholdings and smaller shareholdings. Investors used to send couriers for obtaining information, to evaluate performance of shares. In the later Middle Ages, several Italian city-states commenced issuing marketable government securities. In the middle of the 13th century, Venetian bankers began to trade in government securities. In 1351, the Venetian government outlawed spreading rumors intended to lower the price of government funds. There were people in Pisa, Verona, Genoa and Florence who also began trading in government securities during the 14th century. Later, the fairs conducted in Northern Europe used to be centers of trading activity in shares. In the 15th century, shares of German mining companies were traded. Fairs at Saint Germain near Paris allowed trading in municipal bonds and bills of exchange. The fairs in Antwerp were conducted throughout the year subsequent to permission of free trade. In the middle of the 16th century, the first settled bourse was established in Antwerp. The word bourse owes its origin to the House de Bourse, where traders assembled for exchange of securities. This development gradually spread across many centers in Europe, including Amsterdam and Holland. The Dutch commenced the joint stock companies, which let shareholders invest in business ventures and get a share of their profits, or losses. In 1602, the Dutch East India Company issued the first shares on the Amsterdam Stock Exchange. It was the first company to issue stocks and bonds. In the 17th and 18th century, the French Revolution and Napoleonic Wars resulted in the destruction of the securities markets in Amsterdam and Paris. This gave an impetus to the securities markets in London. In 1801, London stock dealers who were trading in coffee houses formally established the London Stock Exchange. One of the most famous market bubbles of all time reportedly occurred in Holland during the early 1600s. Speculation increased the value of tulip bulbs. At the height of the bull market, the rarest tulip bulbs traded for as much as 6 to 10 times the average person's annual salary. The tulip was brought to Europe in the middle of the 16th century from the Ottoman Empire. Holland's upper classes competed for the rarest bulbs as tulips became a status symbol. By 1636, tulip bulbs were traded on the stock exchanges of numerous Dutch towns and cities, encouraging all members of society to speculate in the markets. Many people traded or sold possessions to participate in the tulip market mania. Like any bubble, it all came to an end in 1637, when prices dropped and panic selling began. Tulip bulbs were soon trading at a fraction of what they once had, leaving many people in financial ruin. On May 17, 1792, 24 supply brokers signed the Buttonwood Agreement outside the premises of the address, number 68, Wall Street in New York underneath a buttonwood tree. On March 8, 1817, the exchange was renamed as New York Stock and Exchange Board. In the 19th century, exchanges commenced trading in forward contract and, subsequently by 1864, in future contracts. Following are some of the major events and milestones in the process of evolution of the global financial markets. 2nd century B. The first organized financial markets was established in the Roman Empire. 13th century. Venetian bankers traded in government securities. 15th century. Fairs in Northern Europe traded in shares. 1632-37. First recorded acid bubble and trading of tulip flowers. 1792. Formation of the New York Stock Exchange heralded the emergence of the exchange markets for equity trading. 1848. Formation of Chicago Board of Trade for trading in forward contracts in commodities. 1850. Industrial Revolution led to economic growth and development. 1864. Commencement of the first futures contract transaction traded on Chicago Board of Trade. 1870 to 1932. Establishment of the gold standard to link the currency value to gold. 1919. Formation of Chicago Mercantile Exchange.
1929. The Great Depression. 1944. Establishment of the Bretton Woods Agreement and led to the formation of the IMF and World Bank, formerly referred to as the International Bank for Reconstruction and Development. 1960-1970. Euro-dollar market. Dollars held outside the United States came to be known as Euro-dollars. In the 1960s, taxes and regulation in United States of America, USA, made it cheaper to borrow and lend US dollars in Europe than in USA. This gave rise to a large market for euro dollars. 1972. Commencement of trading in financial futures at the Chicago Mercantile Exchange. 1973. Abolition of the fixed exchange rates and dissolution of the Bretton Woods Agreement. 1986. Capital investment decisions emerged as a key to infrastructure development, after success of the infrastructure project for building the tunnel under the English Channel. 1988. Mergers. The 1980s saw a wave of takeovers culminating in the $25 United States billion takeover of RJR Nabisco. This event established a benchmark for mergers and acquisitions. 1990s, inflation indexed debt, United States Treasury issued 10-year inflation indexed notes. Many other countries, including Britain and Israel, had done so previously. 1997, Asian financial crisis, originated from Thailand and spread to South East Asian countries. 2000, collapse of the dot-com bubble. 1999, launch of euro as a common currency in the European Economic Area. EEA. 2001, recession in USA due to collapse of dot-com bubble and accounting scandals. 2003 onwards, increase in global commodity prices due to increasing growth in emerging BRIC countries. 2007, peaking of the stock indices worldwide. December 2007 onwards, subprime crisis and collapse of the housing bubble. 2008, global stock markets enter into a bear phase. China becomes the largest producer of gold, overtaking South Africa. March 2009 onwards, commodity and equity markets bounce back in a rally, largely due to extensive imports by China. September 2009, signals of revival of the global economies. Today's global financial markets have evolved over several centuries. The processes and systems have also developed over the decades. With the advent of information technology, automation has facilitated efficient capital flows across global financial markets. 1.4 Evolution of Indian financial markets. The following sections discuss the details about the evolution of Indian financial markets since the post-independence era. Pre-independence period. Equity brokerage industry in India is one of the oldest in Asia. India had an active stock market for about 150 years that played a significant role in developing risk markets as well as promoting enterprise and supporting growth of industry. The foundations of the modern-day stock markets in India commenced in the 1860s. The American Civil War that led to a sudden surge in the demand for cotton from India resulted in establishment of a number of joint stock companies that issued securities to raise finance. This trend was similar to the rapid growth of securities markets in Europe and North America in the background of expansion of railroads and exploration of natural resources and land development. Historical records show that as early as 1864, there were approximately 1,000 brokers, with the stock markets functioning at two locations in Mumbai, between 9 am to 7 pm at the junction of Meadows Street and Rampart Row, from daybreak till 9 am and from 7 pm to early hours of next morning at Bazargate. Share prices of specific companies increased many times during this period. Mumbai, formerly Bombay, was a major financial center with 31 banks, 20 insurance companies, and 62 joint stock companies. An ordinary broker in 1864 earned about Rs. 200 per day, a huge sum in those days. In July 1865, the stock market bubble collapsed. This ended the share mania that was prevalent in those days. An interesting aspect of the trading activity during this period is that despite the creation of such a huge crisis, most of the brokers met their commitment. India's securities markets has transformed into one of the leading and dynamic marketplaces for wealth creation. In earlier times, buyers and sellers used to assemble at stock exchanges to transact shares in open outcry format, flow trading. Stock exchanges were initially established by association of brokers. Equity trading in the pre-independence days was focused on shares from the banking sector. Formation of exchanges provided the issuers of stock to source capital from investors. This facilitated faster growth and development. In the aftermath of the stock market crash in 1865, banks refused to permit brokers from using their premises for trading purpose. Thus, the brokers identified a place for themselves called the Dalal Street. In the early days, brokers used to do business under a banyan tree. Later, a group of about 300 brokers formed the stock exchange in July 1875. This led to the formation of a trust in 1887 known as the Native Share and Stock Brokers Association, which is popularly known today as the Bombay Stock Exchange. A unique feature of the stock market development in India was that it was entirely driven by local enterprise. This was unlike banks which were owned and operated by the British in the pre-independence period. The establishment of the first stock exchange in Mumbai was followed by the formation of stock exchanges in other major cities in India: Ahmedabad, 1894, Calcutta, 1908, Madras, 1937, Uttar Pradesh and Nagpur, 1940, Hyderabad, 1944, Bangalore Stock Exchange, 1963, and Vadodara Stock Exchange, 1990. The stock markets gained from the boom in several industries such as jute, 1870s, tea, 1880 and 1890s, coal, 1904 and 1908, etc. The Bombay Stock Exchange is reportedly the oldest exchange established in Asia. The first reform enacted in India was the Bombay Securities Contract Act of 1925. However, these reforms were opposed by the brokers as they believed that it would hamper their direct interest in stock exchange. Finally, with the promulgation of the Securities Contract Regulation Act, 1956, SCRA, led to the regulation of the capital markets in India. Active trading in shares as well as commodities was occurring at all exchanges across India, until the partition of pre-independent India. Post-independence period markets. The depression that followed independent India led to the closure of several exchanges. This situation continued until mid-1950. The Government of India, which was formed after independence, decided to institute reform in the financial markets. Regulation of securities market was formalized through the Securities Contracts Regulation Act 1956, also known ACRA 1956. Only recognized stock exchanges could operate. Under the SCRA, stock exchanges are tightly regulated as ELF regulatory organizations. In 1956, the BSE became the first stock exchange to be recognized by the Indian government under the SCRA. Other exchanges in Madras, Chennai, Calcutta, Kolkata, Ahmedabad, Delhi, Hyderabad, Bangalore and Indore were all zero recognized. Under the new act, as the economy improved with establishment of development, financial institutions, trading activity started increasing gradually. In 1970s, the introduction of Foreign Exchange Regulation Act, commonly known as FERA, led to the divestment of foreign equity by multinational companies, resulting in increased trading in equity markets. Until the middle of 1980s, the long-term credit requirements of corporate sector was met predominantly by development financial institutions, DF, as well as LIC and UTI. The financial markets did not facilitate a major role in raising capital. The entry of Reliance Group in the early 1980s heralded the growth of a new and vigorous equity culture that spread across the country. Not only was the importance of creating effective and efficient secondary market institutions realized, but also strict regulatory framework was identified as the foundation for the success of Indian financial markets. With the renewed vigor for raising capital in financial markets, new stock exchanges were established in 1980s. Following is the list of these exchange. Kochi Stock Exchange, 1980. Uttar Pradesh Stock Exchange Association Limited, at Kanpur, 1982. Pune Stock Exchange Limited, 1982. Ludhiana Stock Exchange Association Limited, 1983. Guwahati Stock Exchange Limited, 1984. Kanara Stock Exchange Limited, at Mangalore, 1985. Magad Stock Exchange Association, at Patna, 1986. Jaipur Stock Exchange Limited, 1989. Bhubaneswar Stock Exchange Association Limited, 1989. Saurashtra Kutch Stock Exchange Limited, at Rajkot, 1989. Vadodara Stock Exchange Limited, at Baroda, 1990. Coimbatore Stock Exchange. Meerut Stock Exchange. A new set of economic and financial sector reforms that began in the early 1990s gave further impetus to the growth of the stock markets in India. As a part of the reform process, it became imperative to strengthen the role of capital markets. Several measures were taken to implement the processes and systems. Market infrastructure was established to facilitate Indian financial system to grow further and mature. The importance of efficient and transparent market infrastructure came into focus following the incidence of market abuses in securities and banking markets in 1991. The Securities and Exchange Board of India, SEBI, which was established in 1988, was given statutory powers with the enactment of SEBI Act, 1992. The broad objectives of the SEBI include protection of inter-STS of investors in securities markets, promote development of securities markets, and regulate securities markets. The scope and functioning of the SEBI have widely expanded with the rapid growth of securities markets in India in the last 2 decades. The central government or the Securities Markets Regulator SEBI can appoint up to 3 members to a stock exchanges board. It has also the right to regulate the functioning of stock exchanges. The rules, bylaws and regulations of exchanges need to be approved by SEBI. SEBI also supervises the activities of intermediaries and register foreign investors trading in Indian markets. The role of SEBI has been discussed in greater detail in Units 4 and 5. In 1990s, following the recommendations of a high-powered study group on establishment of new stock exchanges, National Stock Exchange of India, NSE, was established. NSE was promoted by financial institutions with the objective of providing access of markets to all investors across India. NSE was incorporated in November 1992 as a tax-paying company. This was the first such instance, because the stock exchanges established until 1992 were formed as trusts being run on no-profit basis. NSE was recognized as a stock exchange under the Securities Contracts, Regulations, Act, 1956, in April 1993. It commenced operations in wholesale debt segment in June 1994 and capital market segment, equities, in November 1994. The setting up of the National Stock Exchange brought to Indian capital markets several innovations. Some of these are as follows: nationwide trading network, electronic trading, greater transparency in price discovery, process-driven operations. These developments had significant bearing on the future growth of the stock markets. In India, faster and efficient securities settlement system is an important ingredient of successful stock markets. To speed the securities settlement process, the Depositories Act, 1996, was enacted. This allowed dematerialization and dematerialization of securities in depositories and the transfer of securities through electronic book entry. The concept of dematerialization and rematerialization is explained in Unit 13 of this course. The National Securities Depository Limited, NSDL, which was established by leading financial institutions, commenced operations in October 1996. Regulations governing selection of various types of market intermediaries as depository participants were instituted. Subsequently, the Central Depository Services Limited, CDSL, promoted by Bombay Stock Exchange and other financial institutions, was also established. Presently, due to the advent of state-of-the-art information technology systems and software, the entire operations of NSE and BSE are automated. Trades are executed electronically, with increased transparency. Now, investors do not have to gather at the exchanges, and can trade freely from their home or office through internet. As of today, there are 24 recognized stock exchanges in India, including the Over-the-Counter Exchange of India for providing trading access to small and new companies, and Interconnected Stock Exchange of India Limited, which is an exchange formed by 15 regional stock exchanges. Nashav IDC TradeMG Network, Electronic Undan, Greater Transparency in price discovery, process-driven operations. These developments had significant bearing on the future growth of the stock markets. In India, faster and efficient securities settlement system is an important ingredient of successful stock markets. To speed the securities settlement process, the Depositories Act, 1996, was enacted. This allowed dematerialization and rematerialization of securities in depositories and the transfer of securities through electronic book entry. The concept of dematerialization and rematerialization is explained in Unit 13 of this course. The National Securities Depository Limited, NSDL, which was established by leading financial institutions, commenced operations in October 1996. Regulations governing selection of various types of market intermediaries as depository participants were instituted. Subsequently, the Central Depository Services Limited, CDSL, promoted by Bombay Stock Exchange and other financial institutions, was also established. Presently, due to the advent of state-of-the-art information technology systems and software, the entire operations of NSE and BSE are automated. Trades are executed electronically, with increased transparency. Now, investors do not have to gather at the exchanges, and can trade freely from their home or office through internet. As of today, there are 24 recognized stock exchanges in India, including the Over-the-Counter Exchange of India for providing trading access to small and new companies, and Interconnected Stock Exchange of India Limited, which is an exchange formed by 15 regional stock exchanges. In spite of the formation of many regional exchange, the launch of automated trading in NSE resulted in decreasing volumes in regional exchange. This is because traders located in remote geographical regions can access NSE through internet. The transformation of the Indian financial markets was heralded by the following major events. Rapid expansion in the funds raised through capital issues. Increase in number of investors subscribing to issues in the primary markets. Automation of stock exchanges and trading activity. Increased regulation, formation of SEBI. Increase in listed stocks, trading in financial instruments such as futures and options. On index and stock. Increase in market capitalization and volume of trade in secondary markets. Entry of foreign institutional investors and mutual funds. The Bombay Stock Exchange developed the BSE Sensex in 1986, giving the BSE to measure overall performance of the exchange. In the year 2000, the BSE used this index to open its derivatives market, trading Sensex futures contracts. The development of Sensex options along with equity derivatives followed in 2001 and 2002, expanding the BSE's trading platform. Historically, an open outcry flow trading exchange, the Bombay Stock Exchange switched to an electronic trading system in 1995. It took the exchange only 50 days to make this transition. National Stock Exchange, NSE, has overtaken BSE to become India's leading stock exchange. The fully automated screen-based trading system provides national reach. The exchange has brought about unparalleled transparency, speed, efficiency, safety, and market integrity. It has established facilities that serve as a benchmark for the securities industry in terms of systems, practices and procedures. Within a short span of time, just 1 year, NSE became the largest exchange in India in terms of volumes transacted. NSE has played a catalytic role in reforming the Indian securities market in terms of best industry practices. Today, the market uses state-of-art information technology to provide the following: efficient and transparent trading platform, automated clearing and settlement mechanism. NSE's products and services offerings are unique. When it commenced operations in 1990s, it innovated to transform the way in which traders can transact. Some of the most important innovations are as follows: demutualization of stock exchange governance, to separate ownership from management; screen-based trading; compression of settlement cycles; dematerialization and electronic transfer of securities; professionalization of trading members; exchange risk management systems using value at risk and SPANFM models. These are discussed in detail in Unit 12. Emergence of clearing corporations to assume counterparty risks, process of novation, market of debt and derivatives instrument, extensive use of information technology. Trading volumes in the equity segment have grown rapidly on NSE, due to the prior mentioned innovative practices. NSE has registered the maximum volume of transactions in stock futures in the world, as per data compiled by the World Federation of Exchanges, up to April 2009. More recently, SEBI has also given recognition to the MCX Stock Exchange based in Mumbai. MCX Stock Exchange is a subsidiary of Multi-Commodity Exchange of India Limited, MCX, India's number 1 commodity exchange with daily turnover of more than Rs. 20,000 crores in commodity futures contracts. MCX Stock Exchange commenced operations on October 7, 2008 in currency futures. NSE has also commenced trading in currency futures, effective from August 29, 2008. Both MCXSX and NSE presently have daily volumes exceeding Rs. 6,000 crores each in the exchange-traded currency futures segment. Another perspective of the evolution of financial markets is discussed in Annexure 2, which contains an article published in the Hindu Business Line newspaper. The list of exchanges and the year of establishment is given in Annexure 1. Students are expected to peruse through both annexures at the end of this unit. The major developments in the Indian financial markets discussed in this section also coincides with increasing integration with the global financial markets. For example, the performance of global equity and commodity markets has a direct bearing on the performance of Indian equity and commodity markets. In this perspective, it is important to understand the integration of the financial markets with the real economy and the specific interlinkages between different asset classes. The same is discussed in Section 1.5. 1.5 Financial markets in the real economy, interlinkages. The need for developed financial markets in India is also due to the increasing interlinkages with global financial systems. The concept of globalization today is no longer restricted to its traditional sense, i.e., variety of cross-border transactions in goods and services, but also extends to international capital flows, driven by rapid and widespread diffusion of technology. In fact, most of the literature in recent years on globalization has centered on financial integration due to the emergence of worldwide financial markets and the possibility of better access to external financing for a variety of domestic entities. Integration of domestic economy with the global economy provides immense benefits. At the same time, globalization can lead to exposure to price volatility in international markets. Thus, it becomes imperative to facilitate market participants to hedge against price volatility. During the 1980s, capital account liberalization came to be seen as necessity, and even as an inevitable step on the path to economic development. This was analogous to the earlier reductions in barriers to international trade in goods and services. However, capital account liberalization also exposes the domestic economy to certain risks. Large capital flow causes volatility, i.e., tendency of financial markets to go through boom and bust cycles in which capital flows grow and then contract. Another risk is contagion, which refers to the inability of the market to distinguish between one type of borrower and another. These risks, if not managed well, could have serious implications, as was observed in the case of East Asian crisis in the mid-1990s. This is also evident in the recent global credit crisis of 2008. The collapse in the housing market was due to the subprime borrowers. Inadequate or mismanaged domestic financial sector liberalization has been a major contributor to crises that may be associated with financial integration. Thus, with GR@R financial integration, developed, vibrant, tough, and stable financial system assumes considerable significance. With enhanced globalization of trade and relatively free movement of financial assets, risk management through derivative products has also assumed significance in India. The Indian corporate sector is exposed to global markets, thereby leading to increased economic integration. They may be required to access international capital markets or have currency exposure. This has led to development of a broad-based, active and liquid foreign exchange derivatives market, which provides them with a spectrum of hedge products for effectively managing their foreign exchange exposures. Derivative markets reallocate risk among financial market participants and reduce information asymmetry among investors. Derivative markets also facilitate efficient price discovery and enable risk mitigation. Thus, if benefits from financial integration are to be maximized, it is imperative to pursue efforts towards a greater sophistication of financial markets and develop instruments that allow appropriate pricing, sharing and transfer of risks. Developed and well-integrated financial markets are critical for achieving the following: sustaining high growth, effective conduct of monetary policy, developing a diversified financial system, ensuring financial integration and stability. Efforts are being made to fully develop financial markets and the financial system. Financial markets today deal with complex and sophisticated products such as derivatives. Introduction of such products would require clear regulatory framework, intermediaries, and development of human resource skills. The progress of financial markets would thus depend on how quickly we are able to meet these requirements. Enhancing efficiency, while at the same time avoiding instability in the system, has been the challenge for the regulators in India. This approach to development and regulation of financial markets has imparted resilience to the financial markets. From the point of view of the economy as a whole, while developing financial markets, it is essential to keep in view how such development helps overall growth and development. The price discovery of interest rates and exchange rates, and integration of such prices across markets helps in the efficient allocation of resources in the real sectors of the economy. Financial intermediaries like banks also gain from better determination of interest rates in financial markets so that they can price their own products better. Moreover, their own risk management can also improve through the availability of different financial instruments. The accessibility of real sector entities to finance is also assisted by the appropriate development of the financial markets and the availability of transparent information on benchmark interest rates and prevailing exchange rates. The approach of the Reserve Bank in the development of financial markets has been guided by these considerations, while also keeping in view the availability of appropriate skills and capacities for participation in financial markets, both among financial market participants and real sector entities and individuals. The Reserve Bank's approach has, therefore, been one of consistent development of markets while exercising caution in favor of maintaining financial stability in the system. In the last few decades and especially since 1991, several reform measures have been initiated to develop the financial markets in India. As a result, various segments of the financial markets are now well developed and integrated. Despite considerable progress made so far, financial markets need to develop further in line with the evolving conditions. In a well-integrated financial system, close linkages develop between the money market, the government securities (GSEC) market, the corporate bond market, the securitized debt market, the forex market and the derivatives market. The increase or decrease in commodity prices depending on demand and supply of the physical commodity may invariably affect performance of economies. At the same time, adverse currency price volatility or interest rate fluctuations can impact commodity prices. Volatility in any one of the market segments gets transmitted to other market segments, although the magnitude of the impact will depend upon the extent of integration. Interest rates prevailing in different market segments would reflect their risk-reward relationships. Exchange rates and interest rates are interlinked. For example, in an efficient market, the forward rate differential on the exchange rate is usually a function of the interest differential between the two currencies for the specific time period considered. As regards the interest rate linkages between the GSEC market and the corporate bond market, any changes in interest rate in one market should lead to corresponding changes in the rate structure of the other markets if markets are well developed and efficient. For example, the yield curves for AAA rated corporate bonds and GSEC should reflect a healthy difference, although not necessarily remaining parallel, along different maturities. If the gap differential between the two yield curves vary excessively for different maturities, it is likely because either or both of these markets are not well developed. Thus, having identified the interlinkages between different financial markets and asset classes, it may be noted that one of the major reasons for increasing interlinkages is due to automation. The impact of information technology on financial markets has been immense, especially in the last 2 decades. Let us analyze the impact of technology and automation on the global financial markets landscape. 1.6 Factors affecting global financial markets. Global financial markets are governed predominantly by the factors impacting different asset classes including commodity, currency, equity and debt markets. Excess demand for commodities or supply constraints can result in price volatility. For example, the price of copper increased from $3,000 per ton to more than USD 8,800 per ton between 2003 and 2006. Subsequently, by February 2009, the price of copper decreased to $3,700 per ton. The increase in copper price led to decrease in the operating profit margin of manufacturing companies that are predominantly consumers of copper. This adverse impact on the operating profit margin of companies has resulted in a decline in their share prices. At the same time, the U.S. Federal Reserve, over a series of Federal Open Market Committee (FOMC) meetings, increased the bank rate prevailing in U.S. from 1% to 5.25%. This led to a collapse of the financial system in U.S. due to the increase in interest costs for subprime borrowers. Housing prices also declined due to declining demand. Repayment of mortgage loans depends on the prevailing interest costs. Increase in the interest rate had an immediate adverse impact on the repayment schedule of subprime borrowers. This led to a chain reaction in the economy. By September 2007, the US Fed was already decreasing the interest rates. But it was too late. The collapse of Lehman Brothers led to a series of default in the international financial markets. Declining confidence among the public, consumer sentiment about the confidence in the economy, resulted in decreasing consumption trends. The entire series of events also resulted in the declining growth rate of global economies. USA, being the largest economy in the world, has a direct bearing on the economies of other developed and developing countries. India has a direct exposure in the form of exports of IT software solutions and services. India also provides manpower to USA in the IT and IT-enabled field. India's very own business process outsourcing, BPO, and knowledge process outsourcing, KPO, are dependent on the US economy. Thus, it is important to understand the performance of the international markets before making critical decisions of financial investments or borrowings. A thorough understanding of the economic indicators is required to analyze the markets worldwide. Financial transactions always require the services of banks, whether acting as principal or an agent, as well as the financial markets in which they can operate. Banks have also expanded their operations to international markets, with the advent of concepts such as global banking and universal banking to ensure a single client window interface. In the late 1800s, the Industrial Revolution resulted in increasing requirements for funds for infrastructure growth. This led to frequent instances of American companies raising capital through new issues in European markets and vice versa. European companies were raising capital in USA, increasing cooperation and financial integration between the financial markets in USA and Europe laid the foundation for the formation of allies. During the World Wars, the Great Depression of 1929 resulted in three prominent events that had great effect on American banking. The passage of the Banking Act, 1933, that provided for the Federal Deposit Insurance System, and the Glass-Steagall provisions that completely separated commercial banking and securities markets activities, or investment banking operations. A 30-year period in which banking was confined to basic, slow-growing deposit taking and loan-making within a limited local market only. The rising importance of the government in deciding financial matters, especially during the post-war recovery period. As a consequence, there was comparatively little for banks or securities firms to do from the early 1930s until the early 1960s. By then, world trade had resumed its vigorous expansion and U.S. banks, following the lead of First National City Bank, subsequently Citicorp, now part of Citigroup, resumed their activities abroad. The year J971 witnessed the collapse of the fixed exchange rate system, in which the USD was linked to gold, and other currencies were linked to the dollar. Floating exchange rates set by the market replaced this system, thereby effectively removing government capital controls. In turn, this led to the widespread removal of restrictions on capital flows between countries and the beginnings of the global financial system that we have today. The effects of competitive capitalism have been seen and appreciated during the past 5 decades as they had not been since 1929. The 1980s witnessed further rounds of deregulation and privatization of government-owned enterprises, indicating that governments of industrial countries around the world found private sector solutions to problems of economic growth and development preferable to state-operated, semi-socialist programs. Most large businesses are now effectively global, dealing with customers, suppliers, manufacturing, and information centers all over the world. Many corporations are repositioning themselves strategically because of changes in their industry and in traditional markets and among their competitors. In Europe, for example, most sizable firms must consider themselves as at least continental players, not just national players. The European market, in the aggregate, is as large as the market for goods and services in the United States. Indeed, it is larger if you include Eastern Europe. It is important for a competitor in any industry to be active in such a market, and equally in the United States. And all competitors seem interested in the emerging markets for goods and services that are developing in the BRIC countries. Brazil, RULL, LEA, India and IGNOU, South Asia and Latin America. Since these regions began to adopt the market recent S in a capitalistic form, global companies have thus become active in world markets as never before, and as the result have become major consumers of international financial services of many types. For capital raising, mergers and acquisitions, and foreign direct investments, for foreign exchange and commodity brokerage, and for investment and tax advice. Governments and financial institutions also have become major users of the financial services for the investment of reserves, the issuance of debt securities, the privatization of state-owned enterprises, the sale of deposits and other bank liabilities, mutual funds, and a variety of investment and hedging services. Global banking and capital market services proliferated during the 1980s and 1990s as a result of not only an increase in demand from companies, governments, and financial institutions, but also because financial market conditions were buoyant and, on the whole, bullish. Indeed, financial assets grew then at a rate approximately twice the rate of the world economy, despite significant and regular setbacks in the markets in 1987, 1990, 1994, 1998, and 2001. Such growth and opportunity in financial services, however, entirely changed the competitive landscape. Some services were rendered into commodities, commissions and fees were slashed, banks became bold and aggressive in offering to invest directly in their clients' securities without the formation of a syndicate, traditional banker-client relationships were shattered, and, through all this, a steady run of innovation continued. New products, practices, ideas, and techniques for improving balance sheets and earnings. As a result, many firms were unable to remain competitive, some took on too much risk and failed, and others were taken up in mergers or consolidations. Market integration has been accelerated by several factors that have occurred during the past 20 years. The absence of need for foreign exchange controls has resulted in a free flow of capital between markets of industrially developed countries. Deregulation has removed barriers that impeded access to markets in different parts of the world, by both issuers and financial service providers. Massive improvements in telecommunications capability has made it possible for information available in one part of the world, such as bond prices, to be simultaneously available in many other places. For example, in 1997, the U.S. Federal National Mortgage Association, FNMA, issued 5-year notes denominated in Australian dollars that were sold in the United States, Europe, Asia, and Australia. These notes were priced at a rate very close to the Australian government bond rate, taking advantage of very strong market conditions in Australia. With India adopting best industry practices for financial systems, increasing integration with global financial markets is inevitable. 1.7 Summary. The earliest known organized markets emerged in the Roman Empire in 2nd century BC. Trading activity has also been noticed in Northern Europe, particularly Germany, Netherlands, and later in France and London. Trading evolved in India with the establishment of the Bombay Stock Exchange in 1875. Several other exchanges were established in India. In the post-independence era, major reforms in Indian equity markets were instituted in the late 1980s and throughout the 1990s. This heralded the formation of the SEBI, National Stock Exchange of India Limited, NSE, enabled the first automated screen-based trading facility. Subsequently, BSE also commenced electronic trading. Financial markets provide the mechanism for the flow of funds from investors who have surplus funds to those who are seeking funds. Technology has emerged as one of the major factors impacting the growth and development of financial markets. Electronic transfer of funds has led to faster transactions, even from remote locations. The globalization of economies has led to increasing interlinkages between Indian financial markets and the world markets. Having understood the evolution and significance of financial markets in Unit 1, we will be discussed in Unit 2, specific concepts related to financial markets and risk management, as well as case examples of historical significance. Thank you. Subscribe to our channel for more updates, and we will see you with the next chapter.